All right. We have an excellent panel. Other people will be joining us in a few minutes. This is very important. Hope you had good discussions in the breakouts. And now we're going to talk about, we wanted to have a plenary session where everybody would get together on a pretty core issue, which is financing for multifamily rental housing. We have a distinguished panel today that we're going to have a good discussion about. I mean, it's pretty indisputable that the financing for multifamily housing, as you will see, is way down, has fallen way, way down. So the question is why, and what can we do about it? And that's what we're going to explore on this panel. Now, let me give you a little background. From the 1990s through 2007, there was easy access to credit characterized our urban development. And this easy access to credit fueled continually increasing real estate values that were ultimately unsustainable. When the bubble burst, real estate values plummeted, billions of dollars were lost, and many banks were forced to close. After that, government interventions and regulatory legislative reforms were primarily targeted at stabilizing the American financial system and strengthening the core finances of banks, not really at ensuring an adequate flow of credit to keep the engines of our economy running. While real estate lending dropped precipitously following the crash, in the last few years, in the midst of a gradual market recovery, lending activity has actually increased, particularly for single-family homes and large multifamily buildings. But smaller multifamily buildings, which traditionally had their credit provided by locally based portfolio lenders, that is, the lenders kept it in their portfolios, still suffer from a lack of available credit, especially in low and moderate income communities. Now, here's something I wanted to show you. Kick this off. In 2006, this is a list of the top 15 multifamily lenders in 2006. If you take a look at this list, watch this. That red lines are going through the lenders who don't exist today, who closed their doors or discontinued their multifamily lending activity. 6 of the top 8, 5 of the top 6, 6 of the top 8, 8 of the top 15 multifamily lenders no longer exist today. So this is just an example of the issue. And these lenders have not been replaced really by other lenders filling in the void. So this is what this used to look like, and it doesn't look like that at all today. So why does the credit for multifamily rental housing continue to be severely constrained in low and moderate income communities? Is it because of new regulations, legislation, lack of borrower demand, banks' own analysis of risk? What can be done to restore ready access to credit for this segment that is so important to the preservation of affordable rental housing and to the health of our low and moderate income communities? I'm very happy that the moderator for this very important panel will be Erica Pothig. A native Chicagoan, Erica is an Institute Fellow and Director of Urban Policy Initiatives at the Urban Institute. Erica recently served as Acting Assistant Secretary for Policy Development and Research at the U.S. Department of Housing and Urban Development. Before she left for Washington, Erica worked on housing and urban development issues with the MacArthur Foundation and the Chicago Department of Housing. Erica was present at the creation of the Preservation Compact. Please join me in welcoming Erica Pothig.
We're good? Thank you. Can everybody hear me?
Yeah.
It is just such a pleasure to be here. I accept almost any invitation to come back to Chicago, but especially when there's the trifecta of Jack, my former boss, Stacy Young, my very good friend, and all the constellation of folks at MacArthur who I also hold dear, and folks in this room. So it's such a pleasure to be here at this important conference and to be able to moderate this meeting of the minds on this particular issue. So we're going to be kicking off the panel today with a presentation by Jeff Smith. I think many of you know Jeff is the executive director of the Institute for Housing Studies at DePaul University, also was at Woodstock for many years. Congratulations, I understand you guys got a nice chunk of change out of the Attorney General settlement that will help you expand your analysis, I think, to many more places in the region, so congratulations. And then our panel will consist of Pam Daniels-Halisi, who is a vice president of Private Bank, has been in this world for a long time, and we're going to tap Pam's institutional knowledge and history as someone who's been lending in this multifamily space for a considerable period. But you don't look young enough to have been, I mean, old enough to have been in this space as long. And then to Pam's left is Mark Willis, who is currently a resident research fellow at New York University at the Furman Center, but we still love to have you here in Chicago, Mark. Now, some know Mark as a resident research fellow. I also know him as an avid bicyclist who gets around New York by bicycle, but has also been at JP Morgan Chase leading the CRA community lending for many years as well. So he's going to add his perspective, important perspective to this issue. And then finally at the end of the panel, you heard everybody's left is Barry Zekas. You heard Barry today talk about one of his important roles, which is as a commissioner in the Bipartisan Policy Commission. But Barry has played many important roles over his very distinguished career, including at the National Low-Income Housing Coalition, Fannie Mae. You were a journalist, I think, at the very start of your career, and serves on some of the most important, the boards of some of the most important nonprofit housing institutions in this country. So with that, let me turn to Jeff and have you kick us off with your presentation on the state of the market.
Thank you, thank you. Is this okay? People can hear me? I'm always uncertain about this. So, all right, I can't see my slides here, so I'm just going to hope that I'm talking about the same thing that's on the screen. So what I'm going to do really quickly is go over just a little bit of information on the nature of the multifamily housing stock in Cook County in the city of Chicago, and then talk about some trends in multifamily financing to hopefully set up the conversation that will follow. So this slide just really quickly lays out the composition of rental units in the United States, in Cook County, and the city of Chicago, and it shows, the big takeaway from here is I think that 30% of the rental units in the U.S., roughly 30% of the rental units in the U.S. in Cook County and the city of Chicago are in these 5 to 49 unit buildings that, I think we've heard a lot about small multifamily over the course of the day so far, and that's really, what we're talking about. There's also a big chunk of rental units in the city and in the county in these 2 to 4 unit buildings, but I think what we're really focusing on here is the segment of 5 to 49 unit buildings that are really concentrated in many ways in the area's low and moderate income neighborhoods. This is a slide just looking at the multifamily stocks, the multifamily 5+ unit buildings, the number of units in those buildings by neighborhood income level. So what it shows is that moderate income neighborhoods, these are neighborhoods where the median income is between 50 and 80% of the area median. They have the largest number of units in multifamily buildings and the largest number of units in 5 to 49 or smaller multifamily buildings. Middle income areas between 80 and 120% of the area median have the second largest number of units in small multi and total multifamily units. And then low income areas, those are areas with less than 50% of the area median income, and higher income areas that are 120% of the area median income, have about the same number of units in multifamily, but the lower income areas have a higher percentage of those units in the smaller buildings. Just quickly going through trends in the financing that go towards these buildings. These are loans for home purchase, for acquisition, for rehab and refinance of buildings with 5 or more units that are originated in Cook County between 2005 and 2011. You can see the light blue line is the dollar amount of loans originated, and the darker blue line is the number of loans originated, and the dollar amount is in thousands. So if you look at 2005, $2.5 billion in loan dollars flowing to multifamily buildings in Cook County. That number declined to close to a bottom in 2009, where we had less than 900 million loan dollars originated to multifamily buildings, and then you see a rebound. Since 2009 and 2011, you have about $1.5 billion to multifamily properties in Cook County. Breaking that down, again, looking at loans going to buildings in neighborhoods of different income levels. I hope this is readable on the screen. But what you see in 2005 is, if you think back a few slides ago, which areas had the most multifamily units? That was moderate income areas. And so it makes sense that moderate income neighborhoods had the largest dollar amount of multifamily loans going to properties in those areas. Next was middle income, and that's the second largest dollar amount of loans going into to multifamily buildings in those areas. And then you see the next highest is high income followed by low income. And those areas, again, had about the same number of units in multifamily buildings, but it makes sense that buildings in higher income neighborhoods are more expensive, so you're going to have more dollars going to buildings in those areas. So you see 05, 06, 07, 08, 09, you see that relationship pretty consistent, where the most dollars are going to moderate income, middle income, upper and lower income. And then 2009, in the midst of a housing crisis, of a banking crisis, you see a dramatic shift where you see loans to properties in upper income areas, high income areas, suddenly growing fairly dramatically. And so by 2011, you see the most of the loan, or the highest number of loan dollars are going to properties in high income areas. There was a 192% increase in the loan dollars to high income areas between 09 and 05. You see following that middle income and then moderate income. So you see a shift in terms of where loan dollars are going. If you look at this slide, it looks at the composition of where all loan dollars are going. You see between 2005 and 2009, it's roughly a 50-50 split between 100% of all the loan dollars to multifamily buildings in Cook County. About half of those are going to higher income neighborhoods, middle and upper income areas. About half are going to low and moderate income areas. Look at 2010 and 2011. That changes, looking at the slide previously, where about 70% of the loan dollars into multifamily buildings in Cook County are going to buildings in middle and upper income areas. This slide kind of looks at the change in loan dollars from 2005 to 2011 and breaks it out by a couple different ways. It looks at neighborhood income level. So if you look at the set of bars on the far, that would be left. That's loans to low moderate income areas. In the middle, loans to middle and upper income areas. And then the far right is all loans in Cook County, right? So this is looking at the change in the dollars in 2005 and 2011. And then it looks at the size of the loan, right? So small loans less than $1 million, middle-sized loans $1 to $3 million, and large loans over $3 million. So it looks at the change in the volume of lending of loans of these sizes in different neighborhood income levels. So what you're seeing, you see a lot of negatives, right? Across the board between 2005 and 2011, you see a decline in overall lending in most of those categories. So small loans to low income areas had the biggest decline. The one thing you see that's different is you see an increase actually in larger loans to properties in higher income areas, which I think is a significant thing to kind of keep in mind in terms of as we think about what's happening in the loan market in Cook County, is that there's been a shift to lending to higher income areas and especially larger loans to properties in higher income areas. And the panel discussion will go into why that's happening. One of the reasons, though, is there's been a change in who is making loans in Cook County. This is a slide looking at the change in lenders that are active multifamily lenders in Cook County. So lenders that made at least 5 loans to multifamily properties in Cook County each of these years. And it's broken out by small lenders. These are lenders with less than $1 billion in assets, mid-sized lenders with between $1 and $10 billion in assets, and then larger lenders with over $10 billion in assets. And the top line, the dark blue line, is the number of small lenders active in Cook County. And you see that declined from 73 lenders in 2005 to 23 lenders in 2011, so a decline of about 50 institutions, lending institutions active in that segment of the market that were smaller entities, right? So if you look at the middle-sized and larger lenders, you see a little fluctuation, but you don't see the dramatic decline in the number of participants in that active in this segment of the market. This is sort of reflective of bigger changes in the Chicago area banking industry. Chicago and Illinois have historically had a lot of banking institutions, a product of laws that made it difficult to or impossible to open up bank branches. So instead of having one bank with a number of branches, you had lots of different banks across the state. So we had a lot of community banks in Illinois, and particularly in the Chicago area. That's been changing as regulations have changed to allow for more branching, for more consolidation. You see the number of institutions active in the Chicago area actually declining pretty significantly between 1992, 2002, and 2012. You see the decline in banking institutions go from about 438 in 1992 to 170. This is a product, again, of consolidation of entities within Illinois, within Cook County, or the Chicago area, so you have fewer institutions that way. The acquisition of local entities by entities outside of the Chicago area, or the failure of institutions as a part of the recent financial crisis. But the end result of this is a lot of these banks are community banks. You've got fewer community banks, and if you look at this slide, fewer community banks that are actively, fewer smaller banks that are actively making loans to multifamily properties. And if you look at this slide, which breaks out loan volume, so this is another slide looking at the change in loan volume between 2005 and 2011. And the way the data is cut here is looking at the size of the lender, right? So again, it's small, medium, and large lenders. The top line, the gray line, is large lenders. So you see, again, at the beginning, you saw large lenders and you saw small lenders having roughly the same market share in Cook County. If you go to 2009, you see again, they have roughly the same market share, much lower, or a much lower volume of loan, but they're making about the same dollar amount of loan. But again, after 2009, you see a change, and you see small and mid-sized lenders essentially having a flat level of lending to multifamily buildings. You see big lenders having a big jump in the loan volume of multifamily buildings. So if you look back a few slides, you see there's a big jump in large loans. There's a big jump in loans by larger institutions. It makes sense then that a lot of the increase in lending between 2005 and 2011 has been large loans by large lenders. So of all the different types of lending that have, looking again from 2005 to 2011, looking at this, it breaks out lending by loan size, 1 million, 1 to 3 million, over 3 million, and then by the size of the lender. You see at the far right, the gray bar, the only type of loan, or the only category of loan that has gone up and gone up dramatically, large loans by large lenders. And if you were to look at this same chart by the income level of the neighborhood, you'd see a similar pattern. The only type of really lending that's gone up over that period is loans in upper income areas by large lenders. So there's a shift in kind of where multifamily loans are going, who's making those loans. I think the rest of the panel is going to sort of explore and discuss why that might be.
Great. Thank you. Sorry. My goodness. This is an inopportune time to get a frog in my throat. All right. Thank you, Jeff. That was really interesting. So Pam, you've been in this space. We established that. Give us a little bit of perspective about what are some of the dynamics going on, particularly within your bank and your kind of competing institutions in relationship to the decline of lenders in this particular space, but also the kinds of opportunities there are for financing?
I could give you a perspective of just even looking at my own career in this space. When I first got in community development was in the 90s. And the larger banks in town, because of pressure, also had established neighborhood lending groups. And so they had full staffs of maybe 2 to 4 lenders who went into the space. And I want to, as I looked at some of the trends that Jeff had presented, it made me realize how lucky we are to have an organization in Chicago like CIC that has sort of been steady, because this notion of private capital and banking capital, it just kind of swings and goes and it just moves out. It's in so many ways not a big barrier to entry that we'll be doing it for 4 or 5 years and we get out-competed. So my career started at LaSalle Bank, and we had a neighborhood lending group, community development group, that we focused on low to moderate income neighborhoods. And we were competitive with Harris and First Chicago, JP Morgan Chase. So all the banks, the large banks, had such a group as this. And we were competing with CIC in a sense. CIC opened up the doors. We might have all provided CIC with capital, but they had a model that showed us how to do it, and we competed with them. We did that, but we also did it in a way that was when a developer came in with an application, and we had a lot of buildings in a lot of the neighborhoods that were vacant. I always say I had in my drawer, I had some leather saddlebuck shoes, and I had a big 9-volt flashlight, because one of the appeals of someone calling you to say, I've got an acquisition, and they tell you the address, they would always sort of hem and haw about the location, or they'll say something really nice about the building, but it was always nice to just say, well, is it vacant, or how many, do you have any tenants in it? And you would hear the sigh of relief that this developer is thinking, oh, okay, so she knows that this is possibly a building that's not fully established, and that I might know something about the building across the street. And they were just, in so many ways, glad to have access. Glad to have access that they don't have to lie about what's going on in the community, and you can kind of vision with them how they're going to make improvements. So I would say that went on through the 90s, but we also were pretty strict about, you have to give us plans, we want a detailed scope of work, we are going to hire an inspecting architect and you will pay for it, and they're going to look at this scope of work with us, and we've got this whole plan that we're going to work out. In time, after we had done this and had volume to maybe do 30 to 50 million a year, we were outcompeted with community banks. So there were other banks that came into that space that probably said, don't worry about all the nuts and bolts that they're going to ask you for, and let's just get this done without all the things they're going to take you through. And then also, I think in that space, the other thing that sometimes we don't talk about was that the condo market came about in Chicago, that a lot of transactions that were happening for values that were based on a building being turned into condominiums. And I'm not sure that those same neighborhood lending groups that were established were necessarily set up to transition into doing condominiums. And some of the smaller community banks were pretty competitive at doing that as well. You get the appraised value, you talk about turning the building to condo conversion. So frankly, even within my career, I did not do, in my whole career, I think I may have done 2 condo conversions of 6 flats. So that wasn't our business. So in a sense, some of these, with the banks condensing and changes and things, but that also happened. I was at LaSalle, and then we were doing so many other things, so I can't really say that multifamily no longer was our bread and butter. We did it, but it was not the core of what we did.
This is once the condo market started competing for the,
So a lot of the clients, a lot of multifamily investors who were interested in multifamily long-term rental were sitting on the sidelines in a sense. People who I would like to be my clients in that space did not like to buy properties for $50,000 to $70,000 a unit. They had no, that wasn't, they had no interest in leveraging up that much. So the next phase, I would say, in my career is that I ended up, when LaSalle was purchased by Bank of America, Bank of America's model was that of, I would always say, affordable housing with a capital A. Very much the core of what they did was low-income housing tax credit deals. So there were deals with layered financing, tax credits. These transactions were definitely over $5 million. Could be $5 to $10 million transactions. So that was that was the model that they did, and I did that for a couple of years. So now I'm a private bank, a smaller bank, much smaller bank than LaSalle, but it's just me. So I do community development and I do our investments. So there's no staff of 10 to 12 people to do the whole kit and caboodle. So I do multifamily. I do have multifamily clients, but yeah, I have to, I don't have a shingle out to say, let me take in lots of applications. I do multifamily with those clients that I have.
Now, is there something that's changed in terms of did the banks hold things on portfolio, right? And are they still holding these loans on portfolio, or are they packaging them for the secondary market?
I think when you're talking about a conventional bank, I think most for this type of property they would hold it.
Okay.
Yes. Now, if you're dealing with the larger banks that are doing affordable housing, low-income housing tax credits, their model is different in there.
So
there may be a part of their note that they do.
These 5 to 49,
Yeah.
these are portfolio loans. So as I ask my own questions for a little bit, I want you to be thinking about yours. And you've got cards here on the table. And if you've got a question you want to ask the panel, please hold the card up, and someone will be by to collect it. Thank you, Pam. So Barry, you were in this space once too, and I'm wondering how you hear the experience in Chicago, a little bit of Pam's history too, which was really helpful. How does Chicago stack up nationally in terms of this kind of lending dynamic, both historically and then forecasting up to today? What's your sense of the national picture?
Thanks. This challenge of providing a secondary market execution for smaller multifamily loans is one that has been on the front burner of GSE conversations way before the current crisis. And just a quick history, both Fannie Mae and Freddie Mac originally were chartered basically to provide single-family finance, and Fannie Mae only got into multifamily finance in any kind of significant way in the mid-1980s, and it did so following the very disastrous experience of FHA, which had created a co-insurance program to try to expand the scope of its insurance programs, right, to sort of get more volume and have a bigger presence in multifamily lending. It turned out to be a terrible mistake in the way they designed it, and the Fannie Mae program, which was first really put into place in the mid-1980s, tried to learn from that mistake, and instead of underwriting the properties, which is how HUD went at it, said we're going to underwrite the lenders, and we're going to require the lenders to have a significant risk-sharing partnership with us in terms of the top loss on any multifamily, and then we're going to underwrite them to see that they're actually good for it. And this was exactly out of the experience with multifamily in FHA, where FHA underwrote the properties. The lenders didn't have any capital at risk, or only a very thin layer of capital at risk. And when it turned out they were wrong on the properties, the insurance claims just mounted right up, and the lenders were nowhere to be found for recourse. So the Fannie Mae model is based on having strong partners, and in the Fannie Mae model, you underwrite the lender, you underwrite their capital, and you try to create an efficient system that relies upon the ability to do big transactions that spread the risk across a lot of units at fairly large volume. And that DUS program is very, very successful, has very low failures, but only is relevant in certain markets. And as you saw from Jeff's slides, that picture is not very different than the rest of the country. These larger 50-plus units are kind of the exception for space affordable housing, not the norm. Now, the Chicago market, in my experience at least, is, I wouldn't call it sui generis, but it is one of a handful of metropolitan areas that has this kind of very interesting smaller multifamily stock, very, very heavily in the neighborhoods. And you see a couple, Los Angeles has a similar kind of thing, some in San Francisco, New York. Mark can talk about much more competently than I can. But then you get into other markets where it's much more of the single family stock, the 2 to 4 stock, and so on and so forth. What I thought about Jeff's chart that I thought was another one of the barriers that when we were looking at this at Fannie Mae we confronted is that we have these sort of arbitrary distinctions between single family is 1 to 4, although we know there's a lot of rental properties in the 1 to 4, but we underwrite them one way. And then we have sort of 5 to everything else. And now people start to talk about 5 to 50s or 50s and up. But really, when you start to think about the market pieces from a lender's point of view, they're really much more graded than that, right? So from my point of view, it seems to me a 5 to 10 probably looks much more like a 10 to 20, much more like a 1 to 4 than a 10 to 20 does, and a 20 to 50 probably looks more like a 50 plus than any of the others. But we have these arbitrary distinctions, and so it's very tough to adopt models. In the smaller property space, what you find in the Fannie Mae model or a secondary market model is you have to shift from underwriting the lender to underwriting the borrower. Right, because the property itself is not necessarily, they don't even underwrite the properties at Fannie Mae. And when you're underwriting owners of small properties, you're in small business lending. And Fannie Mae and Freddie Mac are not competent at small business lending and aren't chartered to do small business lending. And so trying to adopt their model has been very, very hard. And that's one issue. A second issue is that until this crisis, as Pam was saying, this market was dominated by local lenders who knew the market, knew how to do small business, mid-market lending, and in some ways were very anxious for the secondary market not to show up and bring in a new model because they were comfortable making adjustable rate, short-term mortgages that meant that the borrower was bearing the interest rate risk, that as circumstances changed, either in the neighborhood or the economy, you kind of had a quickly maturing loan. The Fannie Mae, Freddie Mac secondary market model is one that standardizes transactions, reduces margins, right, extends durations, and for a lender who's already got a very nice business with a decent margin that they like, that's not a very attractive proposition, unless you're trying to rebalance your portfolio and get rid of the stuff to make room for other things. So we found a lot of barriers to entry coming into the market, and that was true nationally. And then there's just adopting a big national wholesale model, which is what secondary markets really are about, to what essentially becomes, market by market retail lending that really is about underwriting borrowers and taking the risk that small dislocations in a market will lead to big consequences for the property. So, the risk of one unit being vacant for a month in a 100-unit property is relatively small. The risk of one unit in a 10-unit property being vacant for a month is relatively high, especially if your owner doesn't have really deep pockets or a lot of cash flow to cover it. And when you're the lender holding all the credit risk on that, you have to take that into consideration. And when we looked at this nationally, this problem all these issues kept coming up over and over again. Finally, the quality, the Fannie Mae has done an actually very interesting paper in 2010 about small multifamily lending, and they identified all these problems. But one of the others they noted was property conditions in the smaller multifamilies tend to be, on the whole, less desirable from an investor's point of view than maybe professionally managed large-scale properties. And so you always have this issue of is there enough capital to do the renovation? Is it being well maintained? Is the owner capable? And then in that paper, there's a very interesting chart which sort of got to some of Jeff's underlying material about the variety of products that were being offered in 2010 by small lenders to small multifamily properties, and they look nothing like secondary market products, right? They're 3, 5, 7-year duration products with interest rates resets at different points along the way. They're adjustable rate. And those are not products that are necessarily well suited to the secondary or that deliver a good product, a good yield, right, to the seller of the loan. So all those things tend to mitigate against these larger whole-scale solutions. When you look at it compared to single family, the trick of the secondary market is taking millions of individual transactions that are very hard to price and are individually illiquid and turning them into a relatively small number of gigantic, highly liquid, homogenized transactions. That's way, way harder to do in the small multifamily space.
Okay, so you've sobered us up considerably on the prospects of a broader secondary market as a source of capital for this kind of lending. So another major impetus for this lending that certainly has existed since Gail Sincada started organizing people on the streets of Chicago has been CRA. And Mark, you led a major part of community development lending as part of JP Morgan and Chase. What's changed in CRA such that we are seeing the kinds of dynamics that Jeff pointed out?
Right. Well, I agree with all Barry said. There are a lot of similarities across all these markets in the country, but being here in Chicago, one has to acknowledge Gail Sakata. I think that's quite appropriate because Gail and the work that did here with the banks was really leadership, led the rest of the country in those efforts. The way you asked the question, unfortunately, I have to give a rather negative answer here, and I think that's a problem, which is I think CRA doesn't matter as much anymore. So that, as Barry and others said here, it's hard to do these loans. So if you're a small bank and you can make some money doing it, and you know the neighborhood, it works. Right? If you're competing in a market where there's a secondary market and the pricing is not so favorable, as, a lot of banks got out of portfolioing 1 to 4s because of the growth of the secondary market. That was great, but the profitability of this work, I think, is hard. And if you're a large bank, it's hard to do a lot of volume because you get in CRA you get credit for dollar volume. So you got to do an awful lot of small ones compared to some of the bigger ones. And as Jack showed, you can do $300,000 per apartment subsidized housing, right?
Yeah.
Tax credit, whatever. Or you can, make a loan for $40,000 a unit on a small rehab. And so I think the economics are really hard to make this work. And so I think the additional impetus from the Community Reinvestment Act, I think, is really important. And I think we've lost that, right? I think for a number of reasons, one of which, ironically, is that the change in the regulations to make them more performance-based a number of years ago ended up de-emphasizing the number of projects, but more emphasis on the dollar volume. So I think that happened. For those who are in the arcane business of CRA, I'll just mention that multifamily fits under community development lending, and community development lending doesn't get very much credit, I think. Gets extra credit if you do it really well. The regulators have just tried to change that slightly. Well, they've tried to change it. If anything, they've moved it the dial very little here.
So this is in comparison to the kind of single-family mortgage lending that banks are making? Okay, so the implication here is banks are getting more credit for lending on the single-family side than they are for their rental or other kinds of community investment. Okay.
Right. Thank you. For large banks, you get more credit or primary credit for what you're doing in home mortgages, and even small business lending gets something. The lending for multifamily is sort of a secondary consideration, quite honestly. You can use it to help you improve your rating, but it's not the primary way they look at what's called the lending test, which gets 50% of the credit under the Community Investment Act.
And I'd say there's also a contrary push from a regulatory point of view that we heard about when we came here in the commission to meet about small multifamily, and it's related to the shrinkage of the number of lenders, right? There are loans to one borrower rules that regulators, impose and enforce on banks. To the extent you've got fewer of the banks making the loans and the same number of multifamily properties, what we heard from one of the owners was, I keep bumping up against the limit. I mean, the bank I'm doing business with, they think I'm terrific. They go, I can't make any more loans. And then I have to go find some other bank to start making the loans to me. And number one. And number two, the regulatory pressure on lenders now for fully documented, bulletproof, high credit quality loans means the owners are asked to jump through more hoops than they maybe were before.
Gets back to Pam's
point, and it's a barrier, it keeps some people out. And finally, Jack and I talked about this, but when you have properties that were in an underlying market, let's say of a scale of 1 to 10, the underlying market for the last 15 years has been 7. Right? Until the boom, right, when, as we talked about, you get condos going up, the cap rates, all this on the multifamily, and suddenly people are getting loans for properties as if it's an underlying economy at 10. Well, then the bottom falls out, and even if it gets back to where it was, it's a 7, you're stuck with owners who the next time they have to finance that loan are going to be asked to come up with a ton of cash because their property will not pencil out to the same number that it did when they got the last loan. And the bank's position is governed by the regulators who are pushing them to reduce the LTVs and have more capital.
And so, not to get really wonky here, but just on this point, Dodd-Frank, Basel III, increasing I presume these are some of the implications of some of the new legal framework around this lending are putting more pressure on banks. Okay. So this is really sobering, folks, but we're going to lift it up a little bit and look for some of the perhaps bright spots on the horizon. What in a world where we could design the kind of more perfect system for financing, what would the credit models look like that would provide the kind of flow and opportunities for these 5 to 49? And I think, Barry, I take it, maybe we have to fine tune the marketplace a little bit more. What would that look like from your perspective?
One of the things that I would point out, I think Chicago went through a difficult time here with these properties because of the overpricing in condos. And so I think there is a little bit of pendulum swinging here. Don't notice that so much in New York because it didn't happen. So the banks haven't dropped out in the same dramatic way they seem to have here. So the good news is we've probably gone to the end of that swing.
Okay,
and that I think you can expect that banks are going to get a little bit more competitive here and be more willing. And I think you already started to see that in the better neighborhoods, and generally that spills over into all of the neighborhoods. But the critical thing here, and this appropriate also to say here, is CIC. There is clearly a role for this kind of an institution here that can focus, understand the risk here. And, for better or worse, it's a little bit one step removed from the banks and some of their concerns. I think part of what's also gone wrong here is I think that the banks are trying to impose some of the same regulatory restrictions that they've had, put them onto CIC, right? Where, in my mind, CIC is the salvation here. It shouldn't be the only salvation, but I think that it's really important not to make them have to go through all the hoops that others do because there's a clear proven record here of success in doing this kind of lending. It's tough, it's less profitable, perhaps, but it can be done successfully, safely and soundly.
So is this an issue of, is there something that would create an incentive for the banks to do that kind of more wholesale investment from a regulatory perspective or other kinds of incentives that would...
Well, there is one. I've mentioned it. There's the Community Investment Act, right? And I think there's an opportunity here to kind of reinvigorate it, at least in terms of this part of the market, if not for other pieces, because it is hard to do, and the banks ought to get some credit and feel good about it. There's a framework in which you can have that kind of thinking. And probably a really strange thing to say to the owners of properties here, but this may be something that you might also want to weigh in on here, and not leave it just to the advocates to talk about.
Pam, do you have any insights? And then Barry,
No, I wasn't going to say.
Okay, Barry?
So another issue here is there's sort of two sets of issues. One is there credit available for smaller multifamily properties? And is it the kind of credit that people would ideally like to see, right? So sometimes these two conversations get mashed together, right? There isn't readily available 30-year fixed rate, freely prepayable mortgages for smaller multifamily properties. And when you start breaking down the lending model, I'm not sure there should be. That's a different question than is there capital available for multifamily, and if so, how should it be structured? I agree with Mark. I think at some point banks are simply going to have to find some place to put their money, and they're going to have to start earning a net interest margin, and so they'll start to move back into some of these markets. But in the meantime, not only the kinds of entities in the model that CIC does, but there are other things that we might be able to take advantage of. So one would be HUD has a risk-sharing program, right, that it uses with HFAs and Fannie Mae and Freddie Mac. Right now, the only ones using it
HFAs, Housing Finance.
Housing Finance Agency. And one possibility that's been floated up and might be an innovation is to allow CDFIs to take advantage of the same risk sharing, which lets them go in with a little less naked risk taking into these markets, should lower their cost of doing the business, and might, in a sense, act as a draw for other players to come into the marketplace. Some of the role of CDFIs is to actually demonstrate the viability of a market when private interests are unwilling to take the risk. A second is that CDFIs now have access to the Federal Home Loan Bank system, which does provide longer-term financing, and that might become a source for them, as well as the CDFI bond program, which people have just put their applications in for, which also allows for the acquisition of much longer-term credit than has been the case in the past. And it may be that entities like CIC and other CDFIs that in the past have not been in the permanent loan business for multifamily or any other kind of housing might find a niche where they can move in and both do effective, economically effective lending and socially effective lending, because they have a cost advantage that the banks may not have. And they may bring private capital back in as they prove them up.
Interesting. And I will just say, because I was a part of those conversations at the federal level, that CIC's history and activity was a real inspiration for that risk-sharing program that FHA is piloting. So lots to be proud of in Chicago. Mark, we are taking questions now off of your cards, and there are some great ones here, so I'm going to shift to these. And I want to follow up. You noted that this community played a really important role in the creation of CRA. And we have a question from the audience about what do you think the opportunity is for community groups to work with banks to do CRA agreements, again, to address some of the challenges in this market. And I think this one says, Chase did one of these last big CRA agreements in 2004. So I guess this is referring to, yeah, right. So you did it. How, can we do it again? I got it now. Okay. So what are the prospects?
Well, one of the major elements in that prompted these CRA agreements were mergers, and the large institutions are not going to be doing that anymore. I'm very concerned also that banks don't seem to care as much, or may not, about getting an outstanding rating, which is what gives them the impetus to do something extra here. But I think it's a good thing, but there was a long time where community groups and banks worked very closely together, and maybe this is time for the community groups to play a little bit more of an advocacy role. There are exams. The examiners are supposed to be paying attention to what the community is asking, and I think there's still some leverage there to get the banks to at least come to the table and talk about it. And if every one of them does a little bit more, hopefully overall you're going to get some real impact. Yeah.
All right, so that's you're offering folks an opportunity to get engaged in this debate. This next question, Pam, I want to give to you and anybody else to jump in. The question is, how do banks deal with multi-unit rental loans that pay on time but are underwater when it comes time to refinance due to a balloon?
I think probably a lot of banks deal with it very badly. The appraised value still carries a lot of weight. And so, oftentimes you will have clients who say, I pay on time, and I thought that was the point of it. And, that this is, they intend to stay invested and they intend to continue to pay. But that appraisal comes out, which is based on the last couple of years on a market where I would say the big behemoths are selling to the big behemoths, and they are, banks are selling low to investors who want to buy low for cash, and that becomes sort of the comp in the market. There's very little comps that you can draw on that are stabilized, long-term real estate investors who have great properties who are selling their properties at the value of the cash flow that the cash flow represents. I think that this will improve over time. It may get worse, still kind of right at the bottom for another year or so. And it's unfortunate, but in some ways you do have to watch that trend that Jeff presented of the high income, because whereas commercial real estate groups of all banks probably across the country had to contract and get smaller and be a smaller portion of the asset size of the bank, they've done a lot, everyone has done that. So there's going to be a lot more funds and capital that are going into the commercial real estate. It's going to be a lot of competition. So with that competition, they will start to come down market. And I know that for multifamily investors who are in the space of the 5 to 49, if they were to call a lot of banks who have commercial real estate groups, they probably would not get the attention that they deserve because of the loan size. That they will say, well, we really only want to deal with $5 million or up. So if you have a transaction that is only $1 million or less, or heaven forbid that you might have a 10-unit building, I'm not sure that you will necessarily find a space, a product line within that bank for that.
You make an important point here, which is the refinancing of existing loans. So what's the bank going to do? The bank's getting paid, and they can foreclose and get almost nothing for it, or they can keep getting their payment. So I think that puts the bank in a very difficult dilemma here, right? Because it's, in some ways, it's violating the conditions of the loan because the appraised value has fallen so low, but they're getting paid. So there's this term called extend and pretend, and banks can do that. And I don't know how many are, but I bet a number of them are. They're not happy. They're not going to make a new loan, but they're better off taking the payments than they are to foreclose and then wait till the value is
I still think there'll be some pressure initially, where for that client, that the first act is maybe that the bank would like you to move it. So
they'll try.
There'll be pressure to move it. You go try to get 3 bids to move it, but then at some point you probably have to come back and say, here are my denial letters. Then we could get to the point.
And they're trying to get more equity, right? So they're trying to get the loan to value down a little bit.
And without regulatory relief, the bank that does the extend and pretend is always subject to the bank saying, you marked your portfolio to market, you have to come up with a lot more equity now because we see the potential for losses. The severities all of a sudden on our projection of your losses just went up by a big factor. So now you have to put more shareholder equity in place, or you have to do something to increase your capital ratio because we don't think you've got the money to stand behind the portfolio priced as it is today. So there are all these conflicting pressures. Regulators could relieve that, right, by sort of extending and pretending as well. I see the trend, the tide running in regulators just the opposite way because they're under so much pressure for having missed this the last time when they could have actually had a role in damping down a bubble. And so now, of course, they're going to fight the last war, and it could end up helping to make this much tougher.
That's right.
And do you have a sense that the appraisals are where they need to be, or are where they should be in the marketplace right now, Pam?
My thoughts about appraisals are that, this one man, I always have this image of them sitting up really high in like an attic or something with their computer, and it's midnight and they're getting the report out. And they're gathering information. I'm not saying that they have to gather the data that they have to gather, but it's sort of one man's opinion written in ink, written that has all this power. And I think that is, so if you can, I'm always telling people, if you think your property is worth something, stand by what you think it's worth. At the same time, because the appraisers wrote up, put in ink the value of properties that probably didn't have those values 4 or 5 years ago, too. So it's just one day, one man's opinion that has a lot of power. And unfortunately, we do, as a bank, we do have to abide by it. It is strong, that loan to value is a strong criteria.
I wonder though, so oftentimes the kind of market data that appraisers can get access to, or that, that they're also wedded to a certain kind of data source. And Jeff, DePaul has contributed so much to the richness of the understanding of the dynamics in the market. Any sense of, to what extent that better data source has potential to be useful in thinking around the kind of values in these neighborhoods that appraisers or others might look at as opportunities?
I think, one of the things that Mark mentioned, I think it's become clear in the data and in the data we've looked at in general, is that Chicago's got a set of submarkets that are strong and weak and sort of somewhere in the middle. And those strong markets, there's better data. There's more sales, there's more brokers out there actively looking at rents, and there's more information on the market in those areas than there are in the lower income areas. And that's always one of the challenges that we face when trying to understand what's happening from a rent perspective in some of the more distressed lower income markets, is that the data quality in those areas just isn't as good. So I would imagine appraisals and such would be more challenging in some of those areas for that reason.
So this next question you may be able to answer, or may be empirical. It might be a research opportunity for you. How important is the long-term occupant property tax exemption for preserving 2 to 4 unit owner-occupied rental units? I guess keeping them affordable.
I don't know what that is, so but I
Yeah.
would,
Do folks know what the long-term occupant property tax exemption is? Okay. Pam, do you know?
No.
Okay, all right. Sorry, whoever asked this question. Do you want to illuminate it? Yeah? Okay.
Long-term property tax exemption is once somebody owns a property for 10 years, but their income has stayed below $75,000, they get a tax break if their income isn't going up, but the property or their value is going up. So it's basically lets them stay in the neighborhood they bought to make better.
So like an income-based circuit breaker, like an income-based circuit breaker on their taxes.
And there's no test of age. It's just 10 years in the property?
so what was the question again, now that I know what it is?
Well, I think your question was, how important is it for preservation, right? For the preservation of affordability.
I mean, I would think it seems like,
Yeah.
it would be good for the preservation of that particular owner's situation. Now, if they want
Yeah.
to sell it and then it goes to another person, then,
Then they can
that sort of changes I'm
Yeah.
assuming that would change the dynamic of that property. So I think that for consistent ownership and neighborhood stability, that seems like it would be a strong policy.
Great. Well, we have a lot more questions here, so I'm going to get to these. You talked about community banks, big drop off, I think, in their kind of activity. Question here is, what should the role of the Community Bank Association, the State Bank Association, America, ABA, what should their role be in relationship to particularly this part of the stock that we've been talking about, the 5 to 49s?
Right. Unfortunately, there's a lot of headwinds here for
Yeah.
small community banks. I think the whole regulatory world has gotten much more complicated, and so I think it's harder to run a smaller bank than it used to be. And so I think that you mentioned those trade associations. That's probably the big issues that they're facing here.
And is the oxygen been kind of taken up by Dodd-Frank and Basel III,
right, yeah.
and they're all focused? Okay.
That's the sense you get. And then the question is, those that's surviving here, what's the best assets for them to put on their balance sheet? And that's where I think the regulators are really important. And maybe this, hoping that, as I said, the pendulum switches here, because I think that regulators have become tougher on real estate here.
So following up on that, there's a question about one particular regulator, the FDIC. And this is for the panel, but Mark, anybody jump in. So did the FDIC overreact to the detriment of multifamily lending in the massive closure of small banks over the last 5 years? So,
I mean, I think those banks were dead. So I saying they overreacted, I think, if they were insolvent banks, I don't know what else you could have done. I think the point, though, that the question indicates here is this crisis caused a major change in the viability of that part of the bank sector, as did the S&L crisis. We've seen this before, right?
Yeah.
We lost a lot of savings banks, or S&Ls. At that point in time.
So the other side of this is, what was their disposition strategy related to the assets? And I know that FDIC did, maybe it was only a pilot in Maryland, but I know that they did some disposition of the assets, some of which I think they might have been larger than 50-unit properties. But do you know anything about the disposition strategy as an opportunity for acquisition? Okay.
You mean like RTC was?
Yeah,
is
exactly.
Is that what you mean? Yeah.
Right. So I think maybe we're over the hump on that opportunity, so, okay.
Well, they certainly didn't do it like RTC, which was a function of the different circumstances that led to some of these failures, which didn't always involve hard assets like real estate, but often involved securities they'd purchased that were suddenly worthless, or other asset classes that they were holding. This question of the role of community banks, how the regulatory framework is changing their viability. You know, if you look over the long arc of the history of banking in the U.S., there was, following the New Deal, a very deliberate federal policy to segregate out the home lending sector, to basically provide a protected space in which smaller banks could function with an advantage on deposit interest paid and other regulatory advantages. You know, once Wall Street figured out how to disintermediate savings out of these institutions, it was sort of the end of the, you know, the beginning of the end. And there's been a steady 40-year history of consolidation, inability to find a profitable niche, or having a profitable niche that's so attractive some big bank comes in and buys you, right? And ultimately, to the extent these are shareholder-owned, you know, that becomes the right thing to do. And I think there's a real question that policymakers have not figured out, which is what is the balance between preserving a certain kind of banking culture, right, on the one hand, and accepting a different kind of business model that means that business model isn't going to work anymore. And we don't have I don't think there's a uniform policy on that, and I don't hear anybody in the regulatory agencies articulating that. And until that gets resolved, we're going to continue to see, I think Mark's exactly right, the banking organizations that I've been dealing with, I mean, just to find somebody who's focusing on housing, never mind small multifamily rental housing, is very, very hard. I mean, they feel they're fighting for their lives to find regulatory exemptions and exclusions from rules they think are designed for big banks but now apply to them. And that's what they're going to keep focusing on, I think, until we get through this turmoil.
So I have another question related to CRA, but then I want folks to be thinking about, are we missing another source of capital here that could be helpful in this particular space? So think about that while I ask a follow-up. Someone has an idea on CRA, and I want to get your reaction. So this requirement that CRA has of bank regulators to encourage banks to engage in community development activities, the idea is, could that requirement be a basis for regulators to assign a lower risk weight to small multifamily loans in low and mod neighborhoods, say 75% weight versus 100% weight? Would that fix the problem?
Sounds like the opposite. I'm missing something here. We're giving less weight to doing...
Less risk weight, so less capital held against that.
Less capital, yeah.
Yes.
Okay. So that's not CRA. So that's on the safety and soundness side, if I can make that distinction. So you want to get full credit on the CRA side and less burden on the regulatory side.
Okay, so this notion on the safety and soundness might be one proposal or one strategy for doing that. Okay.
And there's more general conversation about more regulatory relief, whether it's Basel III or whatever, for smaller banks. And I think, you know, that is consistent with what you've just put in there. So do you have an idea for alternative source of capital?
Well, interestingly, so I do think the FHA may be a sort of nod in that direction. Obviously, you've pointed out that the cash is an important factor in some of this lending, and true of this particular size property?
I mean, I think it depends on obviously the price. So I think in some of the lower income areas where the properties are lower cost, you do see more cash activity than in some of the higher cost areas in this segment.
Okay.
And also like 6 to 12?
And smaller buildings, right, where the prices are. I mean, in the 2 to 4 segment, you see a lot of cash activity, and I would guess in the 5 to 16 unit segment, you'd see a lot of cash activity as well.
And what about pension funds in this space? Is that not a practical option?
Unfortunately, it's one of my favorite topics here. Because pension funds have been talked about for a long time, that they're going to be the salvation. Well, anybody here who is expecting to retire based on the pension funds wants the pension fund to get a market rate return, risk adjusted, because they want money to be there to pay their retirement benefits. So it gets thrown around. It is like in the Mail-to campaign in New York now, pension funds are somehow going to solve the problem. They are not. Right, because pension fund money can't be used to subsidize housing. On the other hand, in New York, we have something called Sunny Mae. So there's a state of New York mortgage agency that guarantees, it takes all the credit risk for multifamily properties. And under those circumstances, the pension funds will lend to multifamily properties. And the good news is pension funds are willing to go out 30 years because they're looking for long-term returns. So there's a little bit of magic that goes on here by Sonny Mae taking the credit risk, actually allowing the pension funds to get a risk rating on the mortgages that they're buying, because they have this insurance that is risk rated. They are able to offer a 30-year fixed rate product, and in addition, they forward commit the rate if there's construction period, so that you know, and it's often done in conjunction with government programs, you know that at the end of construction, here's what the rate will be, here's what the monthly mortgage costs, so you can underwrite the property quite successfully with this combination. So there is a role for pension funds, but it's not what most people think, which is, there's a lot of money there, why can't we just have that? That doesn't exist.
Okay.
And for the risk-return ratio, I think it's important to note that to get this to work for smaller properties, you would still need, I think, an aggregation facility, right? Because you're not going to, this model will not work at least an economical level because of all the due diligence, documentation, all the other stuff that goes into these smaller loans. At some point, it's a very inefficient execution, right? To do all this.
Right.
And so the answer to that, of course, is to take as many of them as you can into one place and put them in a big bundle and invest in them that way, like in a security. But then you start running into the challenge of these are not typically standardized loans, right? It's very hard to find.
So the way it works
so there's ways to do it, but it's more complicated than, I just want to make a point. It's more complicated than there's a 4-unit property, let's get a pension fund.
The counterpart to CIC in New York is CPC, and they do these all the time, and then becomes sort of a commodity that the pension funds can buy because they know it has 100% insurance. They know the quality of that insurance. The insurer, as well as CPC, the originator, would be CIC here, it does all the due diligence.
Right. No, that's my point. You just need an aggregator. Somebody's going to do all that dirty work, and someone has to pay for that.
So, I've started a little bit of research here, and I don't know a lot about New York, about Chicago, and I don't even know how extensive this is in New York, but there are other sources of money out there. The one thing to remark, and we got some owners out here who I intend to tap to learn more about this as well. There are other sources of money. One is for smaller mom and pops, seller financing. Right. There also is maybe you own a house, you can have home equity on another piece of property that you can use for this. And then in New York, I found out the project managers that go and do some of the work in managing these properties, not project managers, but property managers. I'm sorry, property managers. They sometimes have the ability to borrow because they work across a number of different properties, so they have a wider and deeper revenue source. And I've talked to some of those, and they actually will sometimes borrow essentially for the landlord. Actually, they borrow, put in some equipment, and then they get paid off over time. Because one of the most fascinating things about this, and as I was just talking to Barry before, this issue of getting capital by small multifamily has been around a long time, and people keep predicting that it's the end of the world, right? And these properties are still there. Right? Another is, and I'm sure we have some owners in the room here, own lots of different properties. You go to a bank with sort of a different position here if you're talking about, I got 10 or 15 or 20 of these smaller properties than you do if you're trying to go for 1, 2, or 3. So there's a lot for us to learn here about how this sector has survived so well, quite honestly, when you think about all the obstacles that are there.
Well, we look forward to that research, Mark, and thanks for ending the panel on a high note with a little bit of vision for the future. So I think I've learned a lot. I've learned that perhaps standardizing these loans is not the path, but perhaps getting a little bit of standard, maybe commoditizing. Thank you. Tongue twister. Might be an avenue for bigger take-up by other kinds of investors. There's an opportunity to reform CRA, perhaps in the future, and to reconsider some of the safe and soundness criteria that banks are wrestling with right now with all the other kind of regulatory reforms. So some things to chew on and think about, and I think there's generally a recognition that CIC is an incredibly important player in this
Right.
space and worthy of additional investment by a whole variety of different folks. So with that, please
Perfect.
join me in
Hear, hear.
thanking the panel.
Very good.